Good morning. Welcome to United Assets 2018 second quarter market recap. My name is Lee DiLorenzo, and I'm the president of United. Today, I'm joined with Thomas F. Healy III, and together we will look at certain statistics from the latest period and share our observations of various data points that may affect the markets in the short term. A little housekeeping: this webcast is being recorded on July 11th at 11:30 Eastern Standard Time. The material represents an assessment of the market's environment at a specific point in time and is not intended to be a guarantee of future results. The information is intended for educational purposes only. Moving to the second slide, which lists the names of the professional staff that comprise the investment committee at United Asset, I just wanted to take a moment to confirm that we are considered top-down blended investment advisor. And what this means is that our most important lens when assessing the markets is a global macroeconomic picture. And from there, we utilize valuations, momentum, technical, and quantitative analysis. We have several strategies to accomplish the goals of our clients, and our valued staff has the experience and expertise to navigate all climates. I'd like to kick off that the first quarter of 2018, there was a single data point that stood out to us, which was the volatility story last quarter, and it ruled our discussion. But this quarter, we're observing that there's an outsized performance disparity between the 11 industry sectors that comprise the S&P 500. Now, the S&P 500 is a very relevant benchmark as it's comprised of 500 large U.S. companies. Now, if you take note, the dark black line at the zero plot represents the overall S&P 500's return, and the differential is captured by the red oblong circle. You'll see that's a very large disparity. And of the 11 sectors comprising the index, 7 were down through the month end, with positive performance only coming from technology, discretionary, and the energy sector. The sectors that were exposed to interest rate risks, headwinds caused by tariffs, and the strong dollar were down, and including telecom, utilities, and consumer staples. As we saw last quarter with volatility, when we see outsized rates of change, eventually they will revert to the mean, and this month we're seeing already that the underperforming consumer staple sector is now coming back to life. And this serves our key investment philosophy at United, which is diversify, diversify, diversify. Now, to take a look at the key economic data points that are also shaping the recent past and surely to affect us in the coming months, Tom will take us through the next several slides.
Thank you, Lee. As Lee mentioned, there's been a disparity in performance among the various sectors, and there are a number of issues that are driving these. It includes things like diverging global trends, the impact of policy changes such as tax reform and the trade war escalation, and then the question is, are we peaking? We're seeing signs in the earnings and economic data that suggest to us that a peaking may be occurring. First, we'll take a look at the mixed data globally. Here we're looking at the leading economic indicators of the U.S. versus Europe. In 2017, we had a global synchronized recovery in both economies. That's changed this year, where you can see the top line, the U.S. economy continues to expand, where the European economy has really fallen. We at United have taken actions in some of our strategies to reduce European exposure to reflect this reality. Another key factor is policy. On the positive side, we saw a major tax reform bill get passed that's creating a major fiscal stimulus in the economy. We can see that in 2018, 19, 20, and 21, we're going to see a positive impact on GDP growth from the tax reform bill. While that's a positive, there's also a contradicting negative, and that's the escalating tariff war. On the right side of this slide, in slide 7, you can see fiscal policy benefit estimated to be about $800 billion. However, you're starting to see a counterbalance coming from tariffs. At this point, there's about $120 billion estimated impact on the economy from tariff wars. And even today, we're seeing another $200 billion in tariffs being implemented in a tariff war with China. While the overall market has been okay, there's been select pockets of impact. On the next slide, 8, we see on the left side the S&P industrials relative to the S&P 500 performance. You can see that in the industrials, which comprise things like defense, engineering, construction, and manufacturing have been hit disproportionately by the tariffs. At United, we reduced our industrial exposure earlier in the quarter to reflect this concern. On the right side of the same slide, you can see that Chinese companies, or companies with exposure to China, like semiconductors, have also seen an impact. While we've been facing a tariff and trade issue the last several months, there's a growing concern about peaking. And here we see earnings growth for the last several quarters has been very strong. In the first quarter, earnings grew over 26%, and in the second quarter, which they're beginning to report in this last week or so, there's an estimated growth of about 20%. The question is, with about 7% of that 20 coming from the tax bill, how sustainable is that earnings growth going forward? And that's something we're going to be watching very closely. One of the things that's really benefiting the earnings for this quarter is the energy sector. And as you can see on slide 10, that oil prices have moved up considerably in the last year. For the quarter, earnings from energy companies are expected to grow about 128%. At United, we increased our exposure to energy stocks over the past several months due to the fact that we've become more constructive on the fundamentals in the sector. So that's a key focus for us. The other question is the global economy peaking? You can see on slide 11 on the left side, the Purchasing Managers Index, known as PMI. Globally, it's still high. At over 53, that still reflects an expansionary economy. However, you can see that it's off the recent peak, and it's hard to tell if that's going to stop going down going forward. On the right side of the slide, you can see where that disparity that we mentioned earlier exists. While the U.S. PMI continues to expand, you can see detraction in Japan, the United Kingdom, Germany, Italy, and Spain. And the questions the investors are looking at and what we're working at is that going to stop, or are we going to see a move back up? But we're watching this closely. One thing we take some comfort from is the fact that valuations have pulled back in recent months. You can see on the slide 12 that our current valuation is off the recent peaks and significantly below the overall peak. So we're seeing valuations come in a bit as investors' concerns about things we just discussed come to life. On number 13 here, we can see one of the things concerning people is inflation. What we're seeing is that while inflation is up, it's clearly not out of control, and we're not overly worried about it at this point. And then I'll finalize my discussion on slide 14, which shows that economic confidence remains pretty solid. We're looking at the Small Business Optimism Index and the Consumer Board Confidence Index. Both show that they're moving upward and are well above the recent lows. The bottom line, there's a lot of mixed messages in the data, but we're watching these trends very closely to help inform our view in making decisions for our clients. And with that, I will turn it back to Lee for her remarks.
In our opening slide, we had looked at the 11 industry sectors which comprise the S&P 500. And one of the biggest changes to the index is coming in September. The telecommunications sector will be retitled the Communications Services sector. This may not sound like a big deal, but it really is. The index has had an inverse performance relationship to interest rates with the likes of big dividend payers of AT&T and Verizon in the existing telecom sector that exists. Well, with the changes, internet services like Google and Facebook, streaming digital like Netflix, media like Disney and Comcast, and home entertainment like Activision Electronic Arts will now become part of the same group. Well, this isn't your grandma's telecom sector anymore. So both and active mutual funds will need to undergo increased volume as they sell and buy various stocks to realign their funds to meet the stated objectives. It's only a matter of time before the media also starts to talk about this nonstop, which will surely grab your attention. And we just wanted to take this moment to let you know that United's already taking steps to capitalize on the upcoming changes. Now, in closing, we must admit that we've been asking ourselves, is this as good as it gets when it comes to the long-in-the-tooth U.S. equity bull market? The answer we are leaning towards is yes. But please don't panic. Take a look at our client letter that's attached to the email. You can see that our strategies have been adjusting for this all along. And because of this, we do urge you to assess your personal situation and reach out to us to make sure your current portfolio allocation meets your current and upcoming needs. We want to thank you for your time today, and we look forward to speaking with you over the coming months.